You want to find a company that can potentially double, triple, or even 4x your investment in the years to come. Or maybe that is not your investment style and all you want to do is to find steady compounders to add to your portfolio. Whatever your investing style may be, choosing the right company to invest in can be stressful for some, perhaps even confusing, and the thing is you end up sitting on your hands not doing anything, which is then usually followed by you sitting on the sidelines not doing anything and watching the stock price go up and to the right. Does that sound familiar? And you cave and finally bought the stock, but the very next day it tanks. And now you're stuck back holding the stock that you don't even know whether or not it was a good buy in the first place. And after some time, you'd probably just tell yourself, you know what, I'll just hold on to this. When it's break even, I'll sell and at least get back my capital. And you end up saying things like, this is not for me. Investing is like gambling lah. Buy T-bill safer, 3.5% return. Not bad lah, not bad. If that's you, listen on. Because over the years, I've picked my fair shares of winners and losers. And what I'm trying to do here is just to document the process I use in picking my investments so that you can learn from my mistakes and avoid the pitfalls and the heartaches that I had to suffer through and hopefully shorten your learning curve. You see, there are patterns to observe in both winners and losers in the stock market. And the thing is, it's not just about the steps that we have to go through. So you have to stay to the end to see how we actually draw a relationship between the different steps to give us a deeper insights of the company. So let's begin. So basically, the first thing I like to do right before I start any investment is to understand which part of the business cycle my company finds itself in. Because this basically helps me inform the expectation I have of the company moving forward. Now, if you ask me, understanding the business cycle right is a way better method for us to basically risk adjust our portfolio. What do I mean? Now, if you are someone that is risk adverse, rather than choose a company that the price don't really move, what you actually need to do is to find companies that are later on in the business cycle, companies that are profitable or companies that are mature, so that the profit margins are more secure, the profit margins are more stable, and the cash flow that is generated by the company, right, you are basically able to project it out with a higher degree of certainty. And so the 5 stages of business are basically goes from startup to hyper growth to sustainable growth to profitable, mature companies, and then finally actually number 6, declining companies. But we don't talk about declining companies in this video here. Now, each of these stages of the business cycle, right, have certain characteristics that basically help you to identify these companies. Now, startup companies can be quite hard for retail investors to invest in because you basically give the founder the money, and in this stage of the investment, right, basically the revenue is quite uneven. There's definitely no profits here, and so what you're hoping here is for them to grow the business to such an extent that they're able to IPO and list it on the stock market, and that is when you're able to sell for a profit lah. And so of course the profit here when you invest in a startup business is naturally much greater than what you can typically find in the stock market, but the risk is greater because you're locking in your money with no way to take out your money. You can't just sell your shares. You can't just ask the founder, hey, give me back my money, I need it, right? And the second thing is basically for most startups, right, they end up going bust. And when they go bust, right, chances are you may not be able to receive back a lot of your capital. And the second stage of the business cycle, right, is basically hyper growth. Now, you can find these companies on the stock market, and basically the focus of the management here, right, is to grow revenues at an increasingly fast rate. So what do I mean here? I don't mean every year I grow revenues by 20%, 20%. What we are looking for in a hyper growth phase is for management to grow revenues at an increasing rate, 25% this year, 30%, 35%, 45% in the following year and things like that. So what we are looking for is revenue growth and not so much profitability. Now, however, for me, right, when I actually look at companies in this stage too, I like to choose companies that actually have a positive gross margin, which means at least the revenue minus the cost of goods is a positive number. And so we come to the third stage of business cycle, which is basically sustainable growth. Here, right, basically what we're looking for, yes, we still want revenues to keep growing, but what we're interested in is to see that the business has turned an operating profit. So what this means is after I provide my goods, after I provide my services to people, minusing off the cost it takes to produce these goods, minusing off the cost it takes to run my business, at least I am still profitable. So this is why I call it sustainable growth, because this is where the company starts to actually run an operating profit, which means that they can actually sustain their business without having to have too much external investments already. However, at this stage, right, it's not necessary that the company generates a net profit, because at this stage they may still be reinvesting a lot of their operating profit back into the business to generate a higher revenue. Now, the fourth stage of the business cycle, right, involves profitable companies. Now, what this means, right, is the company actually generates a positive net income. Even after paying off all the expenses and all the taxes that I have to pay, I'm still profitable. Usually these companies have just turned profitable, and what I'm looking for is that for companies to maintain this profitability for 6 to 8 quarters before I consider them a more mature company. And that brings me to the fifth stage of the business cycle, which is basically mature businesses, where their profit margins are more or less stable already. And what we are looking at is the ability of the company to generate positive free cash flow that can be returned to the investors either through dividends or share buybacks and things like that. So another aspect of the business that we need to understand, right, is how your company generates revenue. You see, every single company, right, has its range of products and services that it sells to people to make money, and you have to understand what is it that your company sells, which product, which service generates the most revenue for your company, so that you can actually assess, right, how many people want to buy it, which actually brings us to the next point, and that is the total addressable market. You see, your company has its range of products and services. You have to understand what problem they solve, who is it that are actually buying these products and services for your company, and then you got to assess whether or not these people will keep buying these products and services from your company into the future. And so that is what total addressable market is, the number of people, the amount of people that will continue using your product in future. And we want to make sure that our company is serving a market that is always expanding. You can have the best product and services, right? But if you are serving a shrinking market, right, over time your revenue will definitely shrink as well. So let's consider this coffee shop that we own. Okay, let's say we open a coffee shop in a new HDB estates when there are about 10 HDB flats, right? If let's say every single month we track the number of customers that we have and we realize about 3 blocks of HDB flat people, right, basically come to our coffee shop every single month, then you can say that we have about 30% of the market share. So of course what companies want to do is try to always expand their market share. But another way for us to basically increase our revenue, right, is if we are serving an expanding market. So for instance, this is a new estate. The government just built 10 blocks of HDB flat, but we know that in 5 years, maybe this number of HDB flats will double to about 20 HDB flats. And even if we are serving the same 30%, holding on to the same 30% market share, right, our revenue will actually double just because we are serving 6 blocks of residents now instead of 3. So it is important for a business, right, to always be growing its market share. However, one of the ways that businesses like to grow their market share is actually to reduce price, and that is what we call price wars. Although this is good for the consumer, right, as an investor, this is not my favorite way for the company to actually gain market share. Can't be because there's another coffee shop down the road selling their kopi for $1.80. I end up selling mine for $1.40. But it costs me $1.50 to make the coffee and I'm making a loss. This may be a viable short-term plan for you to gain customers, but in the long term, you can't keep selling coffee at $1.40 if it costs you $1.50 to make the coffee. And that brings me to the next point, profitability, which is why we have to consider the financial health of the companies. And we look at the financial statements to tell us this information. The first financial statement we're actually looking at is the income statement. Now, in this income statement, right, basically what it tells us is the revenue of the company and the profit margins. This will give us a clue as to whether or not the company is performing well, whether or not they are growing revenue, and whether or not their profit margins are expanding. So if we talk about growing revenue, right, like I said before, growing revenue is very subjective to the business cycle of the company. Now, if a company is earlier on in the business cycle, in the hyper growth phase or in the sustainable growth phase, then we'll expect a higher growth rate of revenue. However, for more stable companies like Apple and Google, even slower growth rates of 10 to 15% is considered already very good for these companies already. So it really depends on the type of companies that you're investing in. Secondly, when it comes to profit margins, right, basically there are 3 types of profit margins that we actually see in this income statement: the gross profit margin, operating margin, and the net profit margin. Now, what is the specific use for each of these margins, right, will be covered in another video. But just to help us understand what this means is basically how much money I get to keep at the end of each stage of operation of my business. You imagine that this coffee shop that we have only sells coffee, right? So whenever people buy our coffee, that comes in as our revenue. And so the first thing that we actually do is we actually deduct the cost that it takes for us to make the coffee. So this can be things like the coffee powder, the sugar, and things like that. So we just basically deduct the direct cost it takes to make the product or the service that we are selling to people. And that will give you your gross margins. Following that, right, you end up deducting things that it takes to run the business. So what does it take to run the business? You need to rent a place, you need to pay for utilities, the salary of your staff, perhaps even marketing, so that people know that your coffee shop is opening up in this new area. So after you deduct all these operating costs, what you end up with is what we call the operating profit. And from there, right, after you get this operating profit, basically sometimes there are some one-off payments that you have to do, things like income tax and things like that. And so once you deduct these things, what you end up with is the net profit margin. And so this net profit margin, usually people actually look at it in 3 groups: below 10%, 10 to 20%, and above 20%. Of course, generally, if you ask me, I prefer to invest in companies that are in the 10 to 20% range, or even better, above 20% range. However, like I said again, this is highly dependent on the stage of business that the company finds themselves in. If the company is a young company, reinvesting into the company to make the company grow even faster, then I might be okay to accept a company that is not profitable. And so the second thing we need to consider, right, is the balance sheet of the company. And what this tells us is basically how financially healthy the company is. It basically tells us a bit like the net worth of the company, because what we're looking at is the amount of cash that the company have and the amount of debt that they owe to other people. And by looking at these 2 things, we're able to tell how well capitalized the company is and whether or not there's any risk of bankruptcy in the near term. So how does this affect us as investors? You see, as investors, right, when we invest in bigger companies like Apple and Google, we have to understand that even with the high interest rate environment we're in, right, these big companies are not affected as much, which is why we see their stock price keep going higher and higher and higher over the last few years. You see, for Apple and Google, right, the amount of cash that they have far outweigh the amount of debt that they owe to other people. So this spare cash that they have, they got nothing to do with it. They basically use it to go and buy T-bills and get a free 3 to 4% from the government every single year. However, for smaller companies, right, because they are more capital intensive, they require a lot more money to run the company. What happens when interest rates are being raised, right, it's more expensive for them to borrow money. They're able to invest less into their business, and growth tends to be affected during this time. So as an investor, when I pick companies, and I understand that the interest rate environment is as such, what I would like to do is probably to pick certain companies that are less interest rate sensitive. So if you hold companies like Apple and Google, you can also hold companies that are more interest rate sensitive, smaller companies that you know that perhaps in this first 1 or 2 years, they may underperform the market. But once the interest rate environment changes, right, these companies will start to outperform. And so the third component, right, is the cash flow statement. And what this tells us is basically the amount of cash that is flowing through the company. And that is important for us to understand. Because you see, I may have a product or a service that I provide for my clients that costs $12,000, but I don't collect the $12,000 upfront. I actually offer a payment plan where they can pay me $1,000 a month for the next 12 months. So in this case, if I look back at the last quarter, the last 3 months, basically what happens is, although I have made one sale that basically cost the client $12,000, I don't receive the $12,000 immediately. And in the last 3 months, by operating my business, I only received $3,000 in cash. And so this is basically the cash that is generated by operating the business. And what we usually like to do after that, right, is to subtract this thing called the capital expenditure, or capex for short. Capital expenditure in short, right, is basically just you using the money to basically upgrade certain plants, property, and equipment. So in the case of our coffee shop, if you actually buy a new building or you buy new equipment, this will go under capex. Basically things that you need to upgrade to continue running the business. Why do we actually subtract these two? Is because we get this thing called the free cash flow. Free cash flow is basically the metric that all investors like. And why do they like it? Very simple. Because the higher free cash flow you have, right, that means you can actually have more money on hand to basically return to your shareholders in the form of either dividends or share buybacks. So why is it important for us to look at profitability and all these different numbers of the company? Because to me, right, a company with strong profitability tend to have a strong moat, and that is what we need to consider. Moat is basically something that gives one company an advantage over the others. For example, right, Apple is a very, very common example that people use. Apple fanboys and girls, right, will definitely always buy the newest iPhone, newest iPad, newest MacBook, even though it is more expensive than a Samsung, because they like the company. And that is what we call the brand value of the company, which is one of the competitive moats that we are talking about. There are 6 altogether, and the first one I want to talk about is switching costs. And the most straightforward example I can think of, right, is the idea of Adobe. Those of you using Adobe, right, perhaps you have been using Adobe all your life. A lot of your files or things that you have edited in the past, right, is already in the Adobe format, already on the Adobe cloud. And for you to switch to another platform is quite troublesome. But that is for you as a person. So imagine a design company, right, where they actually hire people. Everybody that they hire is all Adobe trained, and to suddenly want to switch their whole operating system to use a completely different software basically means that they need to retrain the whole group of designers. And so basically for that, right, there's a large cost in there for them to switch from one company, Adobe, to another company. And that is something that will make the company want to stick to their original service provider. Now, the second mode we want to talk about is quite straightforward. It's actually called the network effect. It basically means that the more people that are using the platform, the more valuable the platform becomes. Things like Google and Facebook immediately jump to mind. Because they have billions of users every single month, it makes their platform valuable because advertisers want to advertise on their platform. And the third mode that the company have is basically a low-cost advantage or vertical integration. So if you take this coffee shop that we just now talked about, for example, right, having a vertically integrated coffee shop means that you not just own the coffee shop, but you own the farm that produces the beans for your coffee shop, so that you are able to charge the coffee at a lower price compared to your competitors to draw customers, but at the same time, still maintaining a healthy net profit margin. I think the fourth thing we want to talk about, right, is basically intangible assets. And this is basically something, right, that I mentioned earlier about Apple, basically brand recognition, things like patents and things like that. These are intangible assets that are basically a moat to the company. Because if you look, if you buy an Apple and you're an Apple fanboy, you will always be an Apple fanboy, no matter how much the new iPad costs, no matter how much the MacBook or the iPhone costs, right, you will still keep buying Apple over Samsung. The fifth mode there is basically is the economies of scale. So basically, the bigger your company is, sometimes you are bulk purchasing stuff, right, you actually have a bigger discount. Or in like Amazon's case, basically what they have is this large range of fulfillment network centers, right, where actually they can actually give you same day delivery. So for another company that wants to compete with Amazon on same day delivery, basically what they need to do is they need to invest a large sum of money to build out this network that Amazon have already spent the last decade building already. And so that is basically something that basically stops new competitors from entering the market and being as good as Amazon immediately. And so the last thing I want to touch on when it comes to moat, right, is basically regulation, especially when it comes to things like banking and the government sector and the defense sector, cybersecurity and things like that. There are a lot of government regulations that companies need to comply with. And usually what happens is easier for the bigger companies to comply to these regulations as opposed to the smaller companies, because sometimes these regulations will affect the profits that the company is making. And if they already have a large enough profit margin, some of these regulation changes will not affect them as much as it will a smaller company. Just to be clear, right, a company doesn't need to have every single one of the moats that I just mentioned here. They just need to have some sort of moat, and we need to be able to identify the moat of the company and to see whether or not this moat is stable going forward. So the next thing for us to consider is the valuation and the price of the company. Now, Warren Buffett is very famously quoted as saying, price is what you pay, value is what you get. And I think that is very, very true in today's economy, in today's state of the market. Now, let's talk about valuation first. The two main ways that I like to value companies are basically through trading comps, which means that I actually compare the ratios, the financial ratios of the company I want to invest in to other companies in the same business cycle, in the same industry. And the second way I like to do my valuation is basically to run a discounted cash flow model. Now, there is no best way to actually find the valuation valuation, because valuation sometimes is an art and science, but it's to understand the company that you are basically looking at and to choose the correct valuation method. You see, when it comes to valuation by trading comps using the financial ratios, right, you have to pick a ratio that is aligned with what the management is actually measuring. I find it quite strange, right, where people actually try to invest in hyper growth companies, in companies that are in the basically startup phase, and they say that, hey, this PE ratio is so high. But the priority of the management isn't even to make a profit at the moment, but to grow the company and to raise awareness about their product or services. And so when you measure PE ratio, when the management is not measuring the PE ratio, and you tell me that this is an overvalued company, I find it quite a strange way for you to do valuation. So let's take this coffee shop for example. Let's say every single dollar that I make from running the coffee shop, right, the profit that I make from selling coffee, what I'm actually doing is taking that dollar and paying it to a marketer so that they can run more advertisement on Instagram or TikTok and things like that, so that more people will come to my coffee shop. And at this point in time, what I am interested in is filling up my coffee shop to the brim every single day for lunch and dinner so that I can maximize my profit. And I am not interested in making profit right at this moment. It doesn't matter how profitable I am, right, if there's only 10 people in my coffee shop. And so the second way to do valuation, right, is through the discounted cash flow analysis. And the thing about this method, right, is basically, although it is very detailed, there are a lot of assumptions that are built in. And for companies that are basically in the startup phase, companies that are still in the growing phase, right, a lot of these assumptions can actually be quite far from the actual reality of the company. So the DCF, right, is basically a more suitable way for us to basically value mature growing companies, things like Apple and Google, where the cash flow and the profit margin is actually quite stable. So it's easier for us to project out future cash flows. And then we talk about price. Why do I want to talk about price in this moment as long as we know the valuation can buy already? Why? Because there's always, right, this big debate between fundamental and technical analysis. And I think sometimes the thing is not an either or, it's both and. So what fundamental analysis does, right, is basically give you a price range where it makes sense for you to buy the company. But what technical analysis does is to give you an exact entry point where you can buy, and then maybe there's a slightly lesser chance, I wouldn't say a 0% chance, but lesser chance where you experience a sharp drop thereafter. So basically what I do is I use the fundamental analysis, tell me the price range, and then I look at the price chart and start to draw resistance and support. And then when the price of the company reaches the support, then of course I would double down even more. But I don't wait until support, then I start buying, because sometimes it never ever reaches there. I start buying as long as my company is within my price range, but when it reaches the technical support, I buy even more. Now, another thing I like to consider, right, is basically the competency of management. So the first thing I want to see is whether or not the CEO is the founder. Usually, if the CEO is the founder, I prefer to invest in this kind of companies, because usually these kind of CEOs they are more driven. But that is not always true. There are sometimes where the original CEO is basically the kind that can set the vision, but they are not basically the kind of CEO that can actually make the company profitable. So a very good example of this, right, is basically Steve Jobs and Tim Cook. They both basically grew Apple, but Steve Jobs was basically the brains behind it, the innovator. However, Tim Cook is the one that made Apple into the money generating machine it is today. And then we want to look at management's execution. So basically this means, right, every single quarter when they release their earnings, we want to see whether or not they are able to meet the targets that they have set out for themselves. And what we want to see is actually a history of them being able to do it consistently through different economic environments. And the third thing I want to consider is actually management's alignment. This is when the management's compensation packages, right, is aligned with shareholders. And this usually means that if the management manages to push the stock price up to a certain price by a certain date, then they will get a bigger bonus. Otherwise, they will only get their base pay. And this is when you know that the management's intentions are aligned with shareholders. And I like to invest in these kind of companies. And so the next thing for us to consider, right, is basically the future projections of the company. Now, these future projections are given by both management and sometimes even analysts. But for me personally, I actually give more weight to what the management has to say, because this is after all their company, right? They actually know which metrics they are tracking. So for us as an investor, right, it's important to listen to what management say, to listen to what is important to the management and what they are tracking, so that we can track the same metrics moving forward and basically judge them based on what they give us. With analysts, right, they have their own price targets and things like that, but I usually take it with a pinch of salt, because their price target is very, very movable. And as the price of the company goes up, they move their price target up. As the price target of the company goes down, they move their price target down. So really, basically, it doesn't tell me anything about the company. And what I actually like to do with analysts is just to read their reports to give me a different perspective of the company. And so once you have a thorough understanding of the company, right, it's important for us to be able to draw on all these different pieces of information to give ourselves a deeper insight on how the company operates. So you see, for my style of investing, right, what I want to pay attention to, right, is customer growth. Basically, whatever goods or services you're providing, right, I want to see more and more people use your service and use your products over time. How this usually works is that the company pumps a lot of money into marketing. But if your product and services is good, right, you need to pump less and less money into marketing, because people start to use your product, people start to understand the value that your product actually provides for them, and it becomes a marketing in of itself already. So for me, when I look at this, I don't just look at customer growth, I actually look at it in comparison with the amount of money that they spend on marketing. And I want to see marketing costs decrease as the number of customer growth increase, or at least maintain the same. And if you take the cost of marketing, right, and you divide it by the number of new customers you acquire every single quarter, right, this is what you call the customer acquisition cost, or the CAC. So this is one of the ways, right, that you can draw on all the different information that we talked about to give you a deeper insight into the company and to see how efficient your company is. And it's basically a gauge on how good your product and services is. So if you have a good product, you should be able to to decrease your marketing costs over time and basically end up with a higher profit margin. So picking a company to invest in, right, is both an art and a science, and basically this is a muscle that you have to keep exercising in order to get better at what you're doing. However, it's important for us not to just pick one company and to basically pick a portfolio of companies that is robust throughout all the different seasons, and I talk more about it in this video over here.